Hello and our warm greetings to the Chicago Quantitative Alliance Investments Challenge judging panel for the video presentation. We are the team from Georgia Institute of Technology making our video presentation for this competition. At the outset, we would like to thank the CQA committee for the opportunity to participate in this challenge and get hands-on experience of managing an equity portfolio. Coming to our investments team, our team comprises of 4 students of the Master of Science in the Quantitative and Computational Finance program at Georgia Tech. The team members are Eduardo Aguilar, Sushma Tatapuri, Kshitij Singla, and Yashovardhan Jalan. We would also like to acknowledge our mentor, Mr. Pankaj Patel, and our faculty advisor, Dr. Daniel Wigley. Coming to our investment philosophy, we primarily traded on 3 main strategies. The first strategy was pairs trading strategy, also known as statistical arbitrage strategy. This is a long-short strategy which relies heavily on timing and co-integration of various equities. We will get into more details on pairs trading in the next few slides. The second strategy is the well-known momentum strategy, which suggests that the winning stocks will continue to win in the near future and the losing stocks will continue to lose in the near future. Finally, we also made some trades on fundamental factors like news from the financial markets, release of financial reports, among others. Now I would like to hand over to Eduardo, who will go into more details on pairs trading.
Thank you, Yashu. Now we are going to start talking about the pair trading strategy. Pair trading strategy is a well-known and popular statistical arbitrage strategy. A pair is simply defined as 2 stocks that are moving together. So the strategy consists in trading the spreads, not the individual stocks. When a dislocation in the spread occurs, we enter in the pair taking a long position in one of the stocks and a short position in the other. The opposite direction of the trades make every pair to be neutral against the market, which guarantees a low risk profile. We cannot talk about pair trading without talking about co-integration. Different stocks with similar characteristics are affected by the same macro factors. So on the long term, the behavior tends to be the same. But sometimes these similar stocks can experience temporary volatility, which breaks the co-integration for certain time. But at the end, the co-integration makes the stocks return to its original state. The basic idea of the pair trading strategy is use these time frames in which the co-integration is broken, betting that the stocks are coming back to the previous state. Once reduced the number of pairs, we implemented the statistical test to check the co-integration. This is the famous augmented decoupler test. We programmed in Python the ADF test and tested all the possible pairs resulting in 2 basic parameters. The best T statistic to determine the co-integration is -2, and the optimal time window frame to determine the co-integration is 40 days, resulting in only 160 potential pairs and 224 individual stocks. Next, once determined the pairs, we proceed to backtest the strategy for a period of 180 days. The entry criteria was getting the assessed score with absolute value greater than 2. And the exit criteria of every pair was getting a assessed score of absolute value lesser than equal to 0.5. Over the time period, 60% of the pairs demonstrated to be profitable. And now, Kshitij is going to talk about how the backtest procedure that I explained actually conform with the real trades.
Okay, thanks Eduardo for that explanation of the backtest procedure. So these are the kind of results that we got from that backtest, and the return on average was 4.6%, and we had a volatility of about 3%, and our beta was 0.1. Our actual performance actually didn't turn out to be as well. Our return was on the lower side. We got just about break-even return, about -0.14%. but our beta was stable at, it was for the whole period, almost the whole period, it was about 0. But if we look at the difference between, this slide shows the difference between the actual performance and the backtest performance, and the difference does look quite big over here. And I think that one of the reasons why this difference was brought about was because of the in-sample bias. We use the data from a particular time period for optimizing our parameters, and we also use the same time period's data for then running our back tests in as well. So this is something we will look to rectify in our future testing and trades for sure. But apart from this, I think we tried our best to record the actual transaction costs and trading costs into our back testing as well, because we were given the CQA transaction cost of about 0.1%, and we reflected that in our back tests. The other reason why I think that our back test completely differed from our actual trades was because we realized that in our actual trades there were pairs that were broken down. The returns, the co-integration, it broke down somewhere along the line, and we did not check for co-integration. So, like Eduardo mentioned earlier, our entry and exit criteria was primarily based on Z score, and Z score was where we were looking at, but we weren't doing the ADF test on a regular basis to determine if the co-integration was still maintained or was it broken down. And I think this led to our downfall. But now we have constantly been monitoring the co-integration, and if the pair's co-integration has been broken, as we can see from its ADF tests, we immediately change the pairs. And I think we can already see some benefits out of this coming in our recent trades in the last 2 weeks, and I believe this should make a big change. So this is the sector breakdown of our pair trades. And the thing is that actually we tried to concentrate on a few sectors. We picked a few sectors which we thought are especially booming and especially good for pair trading. Like the three pairs that we mainly concentrated on were information technology, healthcare, and financials. But we also tried to keep a diversification component into our portfolio. So we invested in various sectors like you can see over here. And this diversification helped us to some extent, but not all sectors produce such profitable pairs. So that was a little bit about our results, the difference between the results and our actual trades. Yasho is now going to go through about how we plan to take this forward in the future and what rectifications we plan to make.
Thank you, Kshitij, for the wonderful walkthrough. So far, our strategy hasn't worked up to its complete potential, and we have been in the process of bringing in a few changes, some of which have been already incorporated and have produced significant results as well. The second leg of the competition started on 26th January, and since then, we have had a positive return of about 2%. The main takeaways so far is that co-integration can be lost after firm-specific events, like how Kshitij mentioned earlier. So we are now monitoring the co-integration of pairs through the ADF tests regularly. Also, we have been very careful about timing our trades accurately through entering and exiting our pairs for the right Z-score. So our key learning from the trades we have made so far is that pairs trading is not about longing cheap stocks and shorting expensive co-moving stocks. It is strictly a statistical strategy. These were some of our findings, and we hope you enjoyed our presentation as much as we enjoyed participating in this competition. Thank you.